Thanks again, Emily, for joining us from GFOA and helping Alaskans work through how to calculate revenue loss in relation to their ARPA expenditures and planning. So I'll turn things over to you, and thanks for helping us work through these things.
Great. Now, thank you, Lisa. Thank you, Darren, for having me. And we are, because we are the creators of this worksheet, we're also happy to take your questions as you have them. Certainly would encourage you to shoot us an email at ebrock@gfoa.org for other questions that you have, any other questions about eligible expenditures or beyond. But for right now, let's talk really quickly about eligible use category C, which if you look at the law, the American Rescue Plan Act, obviously it's a 600-page law. There's a lot to it, but the one thing that's consistent between states and local governments, or boroughs and cities and states altogether, is the eligible list of expenditures. And this is written in a lot more words inside of the legislative text, but to simplify it down just a little bit, you can spend ARPA proceeds on COVID-19 or negative economic impact of that. Think PPE or expansion of or capital investments and expansions of healthcare facilities. All those things are captured in eligible use category A. You can also spend the money on premium pay for eligible workers. And so you can think about that in the context of either you have premium pay that's eligible workers or your local government. So you may decide to give them premium pay who are workers inside of your government, or there's also a provision where you can provide grants to eligible workers in working inside of your community, but not necessarily an employee of your government. Think warehouse workers or grocery workers, and lots of local governments have deployed that in very useful ways across the country. Third, you can use the proceeds for government services to the extent of the loss of revenue, and we'll talk about that at length in just a moment. And last but not least, you can use the proceeds in investment in water, sewer, and broadband infrastructure. Those do come with qualifications. They typically have to be projects that have been cleared through EPA's drinking water revolving fund and the Clean Water Revolving Fund. And in addition, if you're looking to invest in broadband, there are other qualifications around that as well. But let's dive into probably the most vexing for all of GFOA members is eligible use category C, which is for government services to the extent of the loss of revenue. So inside of the legislative text and in the interim final rule, there's actually quite a bit of discussion about how to carry this out and to make sure that your government understands how you, not only can you calculate the loss of revenue, but also what can you use it on. Let's talk about my favorite picture that showed up, and the only picture that showed up in the interim final rule, which is a graph which tells you like what are the things that you're looking for if you're approaching this category. Well, first of all, you're looking for a base year revenue, and the base year revenue, they qualify that as being the first full fiscal year prior to January 27th, 2020. So if you're one of the lucky few that actually has a calendar year fiscal year, you won the lottery, so to speak. You got an easy calculation ahead of you. But for the most of us, and the vast majority of communities across the country, you're looking at a June 30th fiscal year, or you're looking at a September 30th fiscal year. And so that makes the calculation just a little bit more confusing because they're asking you to calculate on calendar year basis. So the first thing you have to do is figure out what your full fiscal year is prior to January 7th, 2020. Then what you have to do is you have to look 3 years prior to that, because you have to figure out to the extent that your government lost revenue is a gauge based on how much growth rate you had otherwise expected. And the United States Treasury said, you know, an average growth rate expectation is at about 4.1%. If your government grew above a growth rate of 4.1%, you get to claim that above that rate, 4.1%. If your government grew at less than 4.1%, 3 years, full fiscal years prior to January 27, 2020, you get to claim 4.1. So this is actually a pretty good, generous growth rate that the United States Treasury has allowed to be a part of this calculation. Now, once you realize how much you're going to grow, you're going to start at your last full fiscal year You're going to apply that growth rate to the reduction in revenue for every year that you calculate after that. So on December 31st of every year in the covered period, that is December 31st, 2020, 21, 22, and 23, you're going to have to stop and take a checkpoint. What are the revenue points at that point in time, at the end of the calendar year for your organization? Despite when your fiscal year occurs, you're going to measure the actual revenue that you had collected up to December 31st of each one of those years. Now, to the extent that there is a difference between the projected of that 4.1% or higher growth rate and the actual that's collected, that's the amount of money that you're able to collect. That's the amount of money that the Treasury is giving you to say, this is the amount of money that you have missed out on as a result of COVID-19. Now, if that's about as clear as mud, I promise you it's about to get a little bit more clear with our calculator in just a moment. Okay, so the other thing that complicates this calculation is that Treasury's calculation is not our calculation of revenue. Treasury determines revenue a different way than we determine revenue. And you've got to be sympathetic to that. This is the first time in history that Treasury has ever done anything like this. And Congress handed them a bill and said, Treasury, figure this out. So Treasury, what they did, they took the legislation and they looked across the federal government and they said, who else in the federal government collects revenue figures for local governments? Because if we're able to look at another organization or another part of the federal government that already does this, maybe we can mimic that. Maybe we can use that. Maybe we can rely on past statistics of how they do it. And so Treasury did that. They did a scan and they said, oh my gosh, there actually is a part of the federal government that does collect revenue figures for state and local governments. And that's the census. The United States Census conducts a census of government survey of revenues every 4 years from state and local governments. But the United States Census collects only specific parts of the revenue calculation. What's important is everything in your revenue calculation is in except for what they explicitly say is out of the calculation. So let's start with what's out. What's out? You can't claim revenues that you received from the federal government, and they call it federal transfers, even those that are flowing through the state. You can't you can't count revenues that are intergovernmental from your entity to your entity. You want to make sure, got a thunderstorm going on in my above my house. You want to make sure that you do not double count revenues from your entity to your entity. So be extra careful with that. The strangest thing for GFOA members generally is the fact that the United States Census, and therefore the Treasury, does not count revenues from utilities in the revenue calculation. Frustrating part, of course, is that a lot of utilities were the entities that actually lost the money. So it's frustrating in the revenue calculation itself, but nevertheless, you cannot include utility revenue from water supply systems, electric power systems, gas supply systems, and public mass transit systems. All of those revenues need to stay out of this revenue calculation. Fourth, you cannot include refunds and other correcting transactions. So be especially careful when you're looking at modified accrual accounting and you are thinking about sort of accruals and corrections as those occur. Cannot include proceeds from the issuance of debt. So that's an important thing also to leave out. And last but not least, you cannot include liquor store revenues. Okay, so all those things you have to leave out of the revenue calculation. So then you might say, hey, Emily, okay, great. You've literally taken away a lot of stuff. What is in? Well, what's in the calculation is everything that's not listed above. So any of your revenue generated by your underlying economy, meaning enterprises or component units, can also be included. And so a lot of GFOA members have reported back, hey, we're including our airport, we're including ports, we're including sports stadiums, all of those things in the revenue calculation. I know it's not that simple. I know that there are a lot more categories to include in this, But the way that the census defines revenue and the way that the Treasury defines revenue is this simple. So when you're looking at your specific organization and calculating this revenue, got to try to figure out sort of the big picture. If it's not out, then it's in. All right, so we're going to hop over in just a moment to what we call the revenue calculator. So we realize this is not intuitive for finance officers across the country. And so we thought what we would do is create a calculator that makes it a little bit more intuitive, a little bit easier to make that calculation. And if you can, we'll look at this in just a minute, but every major category listed inside of the federal legislation is listed on the front page of the calculator. Your fiscal year end, your calculation date, your base year revenue, your growth rate, your actual revenue, and then in the very bottom, it's going to spit out the revenue reduction or the reduction that you can recoup to pay for government services. And each one of these worksheets includes a calculation, which includes general categories that they've said are in taxes, intergovernmental revenue, other revenues, and then you're also going to be able to calculate the growth rate. Now, let's talk really quickly about the process. As I mentioned, when we were looking at the chart about 5 slides earlier, you're going to be starting from 2019. It's very likely you'll be starting from 2019. So the last full fiscal year prior to January 7, 2020. And as you're looking at that rate, as you're looking at that year, remember, you're going to have to calculate a growth rate from 3 years prior, in addition to every year revisiting this calculator at the end of the calendar year. So the cash that has been collected at the end of every calendar year. Then you're going to compare the projected growth revenue to the actuals collected. An important figure here, and one thing that they've clarified, the United States Treasury has clarified for us, is that if the actual exceeds your projected, so if you collect $50 and your projected was $25, your collection for that year is 0. And we'll show that in the calculator in just a moment. So let me stop sharing these slides. That's a way to calculate your revenue replacement. Now let me get to our actual calculator. So the first important thing to know about our calculator is that it's free and available. So not only does the Alaska Municipal League have a copy of it for you for distribution, but also we have it on the GFOA website. On the GFOA website, all you have to do is word search calculator. Believe it or not, that's one of the most popular parts of our site these days. The GFOA calculator will pop right up for you, and all you have to do is download it from our site. This is the ARPA revenue replacement calculator. As you can see, it is an Excel spreadsheet. It is clickable. You can kind of play around with it. There are specific things that are preloaded into it that you can't change, and there are specific things that you can change. So if you are so let's talk about what you can change. There are certain cells on the spreadsheet that you can click on that you can say, hey, you know what, my fiscal year end date is June, or my fiscal year end date is September. All that does is calculate for you when your base year revenue period is ending, and importantly, the calculation date of that period where you've got to calculate the actuals and the number of months that occurs, because there is that difference between the end of your full fiscal year to December 31st of every calculation date. So again, that's an important thing, because the way that you're calculating this is making sure, from an exponent perspective, you've got to make sure you capture the number of months from the period of when your full fiscal year ends to that calculation date. That's the way that this calculator works. So make sure you've got those 2 cells filled in as accurately as you can. Your fiscal year end date, I'm going to go ahead and put it in June, and the calculation date will be December 31st of 2020, as if I'm calculating for my first P&E report that's due on Halloween of this year. The next section on the very first tab, which again is the summary tab, is your estimate revenue. So this estimate revenue includes all of those three components that are especially important. Number one, the base year revenue, or the full fiscal year revenue prior to January 7, 2020. It also includes the growth rate. Okay, the growth rate, remember, is the 3 years growth prior to your first full fiscal year prior to January 27, 2020. I know that's a mouthful, but it's like 2019, 2018, 2017, 2016. Those are the key dates that you need to know for your growth rate. Then it also calculates your actual revenue. So that is an input that you're going to have to put in order to make sure that you spit out that reduction in revenue number. With those 4 items, with those 4 inputs, this algebraic equation spits out your reduction in revenue, or the number that you can collect from your ARPA allocation to use for government services. Now, the really cool thing about this website, this calculator in particular that I like, is that you can actually jump back and forth between the sheets. Each one of these is a link to the next sheet where you will have a worksheet to calculate each input. So let's talk about base year revenue. So I have calculated, I know when my base year is. It is in fact July to June 2019. So that's my last full fiscal year. That's my base year revenue. And so I'm going to, so now that I know what brackets I'm looking at and what financial statements I'm looking at, I'm going to click on my use worksheet to calculate. And as you can see, here is your base revenue worksheet. Or if you're going along sort of the bottom of the worksheet, here we go. I'm going to move my computer over just a little bit. If you're looking at the bottom of your worksheet, you see the 4 tabs. So you can navigate that way, or you can choose to navigate by link. So I'm going to use the worksheet to calculate. And I go to this long laundry list of what is included in the base year revenue. Now, one thing to pay attention to, of course, besides the description, so these are the general taxes, general sales and gross receipts tax, general licensing and permit tax. Of course, these probably don't incorporate every type of revenue your government has for each one of those categories, but these are the inputs that the census sends to governments completing the survey. So we have designed this specifically off of the way that the United States Census surveys. So if you're following this worksheet, then you are following the census, then you are following Treasury. So then that's a really good sort of track back to source. So if you can follow this as closely as you can, then therefore the United States Treasury can at least source it back to the United States Census. So what I've done, as you can see, you've got my fiscal year ended 6/30/2020. That's pre-fed at the top of the sheet from my summary sheet. So 6/30/2019, as I've already said, is my fiscal year end. I'm going to say I got $1 for property tax, $1 for general sales and use, and then I've got $1 for every single one of these categories, which all of the rest of the selective sales taxes, which includes alcohol, amusements, motor fuels, pari-mutuels, public utilities, tobacco. Remember, tobacco products is not liquor, so that is included in other sales taxes. And as I'm going down, now another important feature of this worksheet, so as I'm adding in all of these $1 that I'm collecting from each tax category, it's adding up to a summary at the bottom of the sheet. Let me show you really quickly. In column B, that is this column in the center right there, you see a bunch of Ys. That's because that means those categories are indeed a part of the category that's additive to the end. Those are allowed revenues according to the United States Census. Okay. Now, what happens though if I come across a category that's an N? So, for example, if you look at this category on row 37 from the federal government, that would be intergovernmental revenues from the federal government. And if this were a classroom, I'd ask you a pop quiz. Why does it say N? It's because you cannot include revenues from the federal government. So you can go ahead and put a 1 there. If you collected a bunch of money from the federal government all day long, you can put revenues in that category, but it does not add to the sum that's below. So let me scroll down to the sum at the bottom of the sheet. Again, as I'm going through this, you see this will be actually a test. So other revenues, we've unclicked or not included proceeds from the issuance of debt. We have not included sale of retail or wholesale liquor, trust revenue, or refunds or other correcting transactions that are not included. So I'm going to go ahead and start adding my $1 collections in each one of these categories. As you can see, if it has a yes, it's additive towards the sum. If it has a no, it is not additive towards the sum. As you can see, I can write all day long a liquor store revenue or refunds and other correcting transactions. It does not add. But at the end of the day, I've collected $14 included in my base revenue, right? I played around with this sheet. I've added in all my revenues, including those that are not included, but that's okay because I have put something in the worksheet that allows for us to not include it. I'm going to go back over to the summary slide or the summary page, and I'm going to look and make sure I have indeed those $14 in my base year revenue. Okay, now I'm going to look at my growth rate. So remember, I am no longer just looking at my first full year, fiscal year prior to 2020. I'm looking at 16, 17, 18, and 19. And as you can see, I've already added $1 in property tax revenue for 16, 17, and 18. And just to simplify this just a little bit, I'm going to make it bigger. So again, as you can see, you've got 16, 17, 18, and 19, which is pre-fed from my base year revenue. And I'm going to scroll down to the very bottom. Now, what's important here is that I'm looking at, the growth rate. Remember, Treasury is gifting me a 4.1% growth rate. If I get above 4.1%, then I get to claim that growth rate. If I don't make quite 4.1%, then I am given that 4.1% minimum. So let's talk about it in the worksheet, in terms of the worksheet. Let's say I have collected in my base year $14, okay? So for every year, I'm going to actually go ahead and collect just $14, okay? As you can see, I have zero growth between 16, 17, 18, 19. But what happens at the very bottom? I've got a 4.1% growth rate. So it automatically defaults to that growth rate that the Treasury allows you to have. So that 4.1% growth rate is what I'm allowed to have. If I was to grow significantly more than I had thought, so I had $9.16, I had $10.17, and $11 in 18, then I'm looking at 11.9% growth rate, which again is above 4.1. So this calculator is going to let me hang on to that 11.9%. So if you're at 0%, you're going to default to 4.1%. But if you're above 4.1%, then you are going to have that actual growth rate. Okay, so let's go back to our summary page and make sure that my 11.9 is built in there. So good. I've got a $14 in my base year revenue. And for the last 3 full fiscal years prior to January 7th, 2020, I've got an 11.9% a growth rate. Okay, we got 2 of the factors done. Now, the most important part and the most compelling part is where you get to your actual revenue. So what's the actual revenue that you have collected as of December 31st, 2020? Those are the actuals that we're looking for here. Now, of course, the important thing, I'm going to scroll down again. You've seen this worksheet a couple times. Our actual collected, again, is December 31st, 2020. And if I go ahead and make that actual collected at $15, we'll go back to our collection, our landing page. And let's think about this. Let's walk through this thought experiment intuitively. I know that I had $14 on my base year revenue, okay? And I used my worksheet to calculate that. Everything's good to go. I know that I was expecting an 11.9% growth rate based on the last 3 full fiscal years, okay? What that means is I should have collected $17 as of my December 31st, 2020. If I had proceeded to grow at 11.9%, then I should have collected $17 as of December 31st, 2020, but I didn't. I collected $15 instead. And because of that, I have a revenue reduction number of $2. And therefore, I can collect that $2 on top of for my government services, for that revenue replacement for those government services. Now, there's a lot of things that you can do when you're looking at this, of course. You're going to have to make sure, of course, that that growth rate is correct, and you're going to have to make sure that you are using either cash method of accounting or modified accrual accounting, whichever one you can get together quickly enough. But there are certainly lots of different methodologies that GFOA members are approaching the reconciliation with. So with that, I won't stop sharing this, but I'm certainly happy to answer any questions that you might have.
Thank you, Emily. That was amazing. I guess one of the questions that we get most often is related to the dates. And could you just kind of, I guess, one, review that again? So most Alaskan communities have a June 30 fiscal year, July through June 30. So where does this place? What should they put in here? Just what you have, and they're just calculating 18 months worth of, is their base revenue or their actual revenues at that 18 months, or is that right? Oh, you're on mute. Yeah.
That's exactly right. So this is the thing that has gotten a lot of people, you're not alone, Alaska, that's all I gotta say. So when you're looking at June to July fiscal year, and they're asking you to calculate those actuals on December 31st, you're technically talking about not just July to June 2019, but July to June 2019 to December 2020. So it adds that sort of 18-month factor, that bridge, those 6 months that are not incorporated in financial statements that you're calculating on the dot on December 31st, 2020. So those orphan 6 months have to be placed back into the calculation, and that's what they did here. So the way that we're calculating that, again, it's an exponential growth factor, and we have to have a divisor, the thing that's sort of the that moderates how much of the growth rate can be attributable to how many months you have. So it essentially gives it a little bit more steam, it gives it a little bit more oomph to give it 18 months worth of an exponent to give you that divisor. Now, as you can see now, so remember, I mean, that 11.9%, that's your growth rate. Should I have had 11.9% in that period of time between the close of my last fiscal year to December 31st, 2020, technically that 11.9% has to be applied to 18 months of growth. And so with that, you've got that $17 counterfactual that pops out. So otherwise it would have been smaller because 11.9% would have applied to only 12 months, but they've got to apply it to 18 months in this case.
And then just one more question from me. So they do it for 2020, and then we need to do it again for the end of this year, right?
Yep.
For 2021. So for local governments who have received a first tranche, they will look at this twice really before they receive a second. They'll be looking at 2 years worth of lost revenue. Is that right? We should run it once now and report on it, and then do it again at the end of this year and potentially apply it to whichever distribution makes sense.
So yeah, your last full fiscal year prior to 2020 is always going to be stationary. That is always going to be your base year. And if you look at the front page of the ARPA revenue replacement calculator, I can go ahead and stick in 2021 as if I was putting in actuals for December 31st, 2021. And what that does is it changes that number right there to 30 months. So remember, that close of your last full fiscal year remains stationary. All that the calculator does is kind of push it out another 12 months and another 12 months and another 12 months. So again, that multiplier remains the multiplier throughout your calculation, throughout the covered period of ARPA.
Great, thank you. Let me just check with any other staff on the call to see if there are questions. And I know we don't want to keep you too long, but Lisa, any questions or common issues that you've run into that you wanted to bring up?
I do have a question. So if you put in your 6/30/19 revenue, and then you go to your is it the growth rate tab, the one with the 3 years?
Yes.
Do you have to put that in, or can you just go with 4.1% growth rate?
I've heard that question before, Lisa. It's a great one. So, well, yeah, I mean, it's a pain to like figure out this specific type of revenue calculation for the last 3 years. I know a lot of people were in a rush getting stuff together, so it's hard to do. I sympathize with that. Theoretically, you could say I had 0 growth rate. I'm going to claim that 4.1%, and that would be totally fine according to the law. They're allowing you to have that 4.1% growth rate despite what your calculation is. Of course, you're leaving money on the table if you would have otherwise grown at 10%, but that's entirely up to the jurisdiction.
Thanks.
Any other things that we've run into? We covered a lot of it, but Don or Darian, any questions that you have?
You know, I really like the way that this is it's just kind of automated, but one of the biggest things that I've heard back from GFOA members is they want to change it. They're like, can you unlock it so I can just go crazy? And while we'd love to, we'd also not like to brand it and have it be changed. So we'd prefer to try to keep the cells locked. And if again, if there are idiosyncrasies with your jurisdiction that don't fit into it, we've tried to type in as many other columns as we can so that you can fit your revenues into those spaces. And the other thing is too, of course, what we have encouraged GFOA members to do, and the one thing I love about AML, of course, is that you guys are a central nexus, you are an aggregator, and so to the extent that you're able to share with one another through AML, as you're trying it, as you're trying to get the right numbers, as you're kind of fixing the kinks, and of course, GFOA is always very happy to be a resource for any of our members in any jurisdictions otherwise about this, just so that we can make it happen. The last thing I would say is, while this is not officially Treasury endorsed, we have gotten many very kind thank yous from the United States Treasury for creating this because it's created a consistent way for jurisdictions, the 38,000 that received ARPA funds, to be consistent in their calculation. And so, like I said, we're very happy to be a resource and really grateful that you had me on this webinar today.
Yeah, thank you. Do we turn this into Treasury, or they just want the algebraic equation?
Well, we'll wait to see. So obviously they just wanted the algebraic equation in the interim report, which was due on August 31st. And really what it was is it was form feeds, but it was precisely the form feeds from our summary sheet. So yes, you can use this to sort of fill those in. We aren't sure what the P&E report's going to look like just yet, or what the portal's going to look like, but they've hinted that if you saw the interim report, you should feel comfortable with the P&E report. So again, importing just the summary sheet or at least having it on file, of course, you always want to make sure you keep it 5 years for audit, but having it and making sure that it remains a tool in your toolkit for audit purposes would be probably a good thing to do.
Good. Well, I don't know that we had other questions. I'm sure members will, but I think we've got enough information to support them. And then if we do run into challenges, we can follow up. I really appreciate your time, the hard work that GFOA put into this. I know it's late for you in the day, but it's been so great to have GFOA out there as a resource and your expertise. So thanks so much from Alaska.
Likewise. Thanks, guys.
Okay. Take care.
Absolutely. Thanks, Emily.
Bye-bye.
Bye.